Good afternoon, ladies and gentlemen. Welcome back to this week weekly market review, which is on a Tuesday, 1st of April, because last Monday was a holiday, and I hope everyone had a good rest over the long weekend. And joining me today, as usual, will be Gerald. How are you, Gerald?
Yes, I'm good. Hi everybody. Now we are on 1st April. The first quarter of 2025 is over. I had a good break over the past weekend, but at the same time, we are seeing quite a bit of market movements. Hope to be able to share the updates with everyone today.
Yeah, I think a lot of investors are looking forward to some of your updates because market has been volatile and very fluid. Last week, we saw some good news on the Singapore side. STI touched a new all-time high above the 4,000 level. But on the US side, we also hear the 25% automaker tariffs in US that caused market to come down quite a bit. And of course, tomorrow the market is foreseeing the what Donald Trump called Liberation Day and what I call Doomsday, and that is the reciprocal tariff that US will be imposing on some of its major trading partners. So I think without further ado, I will let Gerald take you through some of the key highlights for last week.
Hey, thanks, Sunny. The usual disclaimers before we start. Today's sharing is for information purposes only and should not be taken to be financial advice. Okay, if you find our weekly market review helpful, do leave us a review on Google, either by scanning this QR code or going to this URL. If you're wondering how you can join SIAS as a member to access various online resources as well as investor education programs, you can once again scan this QR code or go to sias.org.sg/membership. Okay, so as Sunny mentioned earlier, we saw quite a bit of volatility in the market with the uncertainty around the tariffs. The S&P 500 fell below the 5,600 points with a 1.5% decline in the past week. If I were to look at the top losers, a lot of the top losers were the tech stocks. We see the Nasdaq falling by 2.6%. But what's very interesting to me is that the Singapore market has continued to do well. The STI actually exceeded 4,000 points at one point to reach a new all-time high. But having had some fallback at the end of the week, it's still at a 1.2% gain for the week ending 30th March 2025. If I were to look at some of the key drivers of the market, what we see would be various economic indicators, which actually point to a weakening in consumer sentiment as well as sticky inflation. Okay, so first and foremost, we have this Conference Board Consumer Confidence Index. What we see here is a very sharp fall over the past 3 months, such that it is actually at the lowest point since 2020. Okay, so all of it is reflecting that the uncertainty on the tariff is starting to hit the US consumer confidence. And the question is whether this will lead to a very sharp pullback in spending, as well as leading subsequently to a potential recession. Okay, we also have this chart which shows us the consumer expectations. This is around their income, around the job market. And once again, we see a very sharp fall over the past few months, such that it is now below the 80 level. So the 80 level is seen as a important threshold. Once it falls below the level, it actually points towards a potential recession, which is why investors are looking at this indicator very closely and highlighting whether this is a sign of a very significant weakness in the US economy. We also have the US PCE data, which was out on Friday. This is the Fed's preferred measure of inflation. And what we see here is that based on the personal consumption expenditure data, it rose by 2.8% year on year in the month of February. This is above the market expectation. And what this shows is that it accelerated from the month of January and is still very far away from the Fed's target of 2%. Okay, so based on this, it highlights that inflation still remains sticky. It leads to questions about whether the Fed can cut interest rates as expected. So overall, we are seeing a landscape which is reflected in rising consumer uncertainty, more weakness in the consumer sentiment, but at the same time, inflation remaining fairly elevated. So the question is what this will lead to in terms of the Federal Reserve policy and whether we might actually see a potential US recession. The Singapore market has done relatively well. We see that investors have actually taken notice of the Singapore market as a potential safe haven market. And if I were to look at the top gainers, we have the DFI Retail Group, which went up by 6% after they announced the sale of the cold storage supermarkets in Singapore. Okay, we also have DBS up by 2.6%. The management change actually happened at the end of the month. So we have a new incoming CEO of DBS, replacing Piyush Gupta, who has been with the bank for more than 10 years. We also have ST Engineering continuing to reach new all-time highs with a 2.6% gain in the past week. In terms of the worst performers, we've got Yangzijiang Shipbuilding down 4%, Venture Corp down 3%, with the correction in tech stocks. Venture Corp has come down as well, and Citrum down by 2.3%. So with the share price movements, there are two stocks that I want to talk about today. The first is ST Engineering, reaching actually a fairly high price of $6.79. What we have seen is that the company previously organized an investor day where it provided the latest targets on what it wants to achieve over the next 5 years. Okay, so what did we see in terms of the company announcing some of its recent targets? So if you were to look at the previous investor day in 2021, they actually set out a few targets. The first of which is to grow its revenue at 2 to 3 times global GDP to more than 11 billion. So as of 2024, that has been achieved ahead of schedule, which was initially intended for 2026. Okay, we also want to see the company growing its net profit in tandem with the revenue, and the company believes that it is on track to be achieving that. Okay, so this is what we see for the 2024 revenue. Like I mentioned earlier, it has actually exceeded the 11 billion revenue ahead of schedule. And this is actually driven by both the growth in its commercial as well as its defense revenues. Okay, so if you're to look at the progress, so I mentioned 11.3 billion of revenue. The net profit has grown as well. 2024 net profit of 702 million, and that is an improvement from what we saw over the past few years. As the order book continues to grow, the revenue continues to grow, it's been able to grow its net profit as well. Okay, and the return on equity has improved to 26.3% in 2024, which is much higher than what it was in the past at the low 20% range. Okay, so what we see here is the revenue across the various divisions. We see that the commercial aerospace revenue has been boosted by more maintenance activity for the global aircraft fleet. The Defense and Public Security Division also sees the improvement in revenue together with the boost in defense spending globally. More importantly, we also see an improvement in ST Engineering's order book, 28.5 billion as of December 2024. And that is an improvement from what we see back in 2023, which was 27.4 billion. So with the rise in the order book, as this order book progressively gets recognized in the coming years, that can potentially lead to further revenue growth. Okay, so we look at the latest targets that were set at its 2025 Investor Day. They want to grow the revenue at more than 2.5 times global GDP growth rate to $17 billion by 2029. Okay, they expect to grow the net profit by exceeding the group revenue growth by up to 5 percentage points. And last but not least, they have also announced the increase in dividend per share in tandem with the profit. It's important to take note that all of these targets are based on what are the existing businesses and excludes potential M&A as well as divestments. Okay, how does it intend to achieve that? We see that for the commercial aerospace, they expect to grow the revenue at 2 times the aerospace industry growth rate to 6 billion. Okay. For defense and public security, the revenue is expected to increase to above 7.5 billion. And for urban solutions and Satcom, the smart city revenue is expected to grow by 3.5 times the global GDP growth rate to 4.5 billion. Okay, so adding all of this up, that is how they expect the revenue to be able to exceed 17 billion by 2029. Okay, it was earlier mentioned that with the growth in profit, they also expect to grow the dividend per share. We have seen the company increasing the final dividend per share to 5 cents from 4 cents in the previous year. So that is being rewarded to shareholders. Okay, what the company has also mentioned is that for 2025, with the strong outlook that the company sees, they are also proposing that they can increase the dividend further in 2025 to 18 cents per share from 17 cents per share in 2024. Okay, so this will include an interim dividend of 4 cents per share and a final dividend of 6 cents per share, bring the total dividend to 18 cents per share. Okay, so what we've seen for ST Engineering is this steady increase in dividend, and it's expected to increase further in 2025 to 18 cents per share. But even with the 18 cents per share, we see that the dividend yield is just at about 3%, having with the share price going up very sharply over the past year. And this 3% dividend yield is below the historical average dividend yield of 4%. Okay, likewise with the PE ratio, we see that it has now gone up to above the historical average at about 22 times versus the historical average of 18 times. Okay, so that was ST Engineering. The next stock I want to talk about is Sembcorp Industries, which is another stock that has helped to lift the STI, with the share price going up to $6.34 as of Friday. Okay, so Sembcorp Industries is another name that we have seen growth in the profit over the last few years. In 2020, it was at 301 million, and in 2024, it was at 1.019 billion, representing a 36% CAGR over the past few years. Okay, if I were to look at the growth in the profit, a big part of it is the growth in the renewables capacity. We see here that they are targeting 25 gigawatt of installed capacity by 2028. We have seen this grow from 3.2 billion in 2020 to 17 billion as at February 2025. Okay, so the company is also adjusting itself to be able to tap on opportunities in the renewable sector. And if let's look at where some of this renewable energy capacity is, we see that it is growing its capacity in China, in Vietnam, as well as in India. So all of it is helping to boost the capacity to 17 gigawatt as of February 2025. And that is helping to boost its confidence towards being able to meet its target of growing its renewable capacity further over the next few years. Okay, and also with the growth in its profit, is increased its dividend, like what we saw for ST Engineering. For 2024, we saw an interim dividend of 6 cents and final dividend of 17 cents, which would bring the total dividend to 23 cents for 2024. Okay, so for Semcom Industries, the current PE ratio is at about 10 times, slightly above the historical average, but not near where it was in the previous peak as yet. And what we see in terms of Semcom Industries is that generally we have seen the profit growth just like what we saw for ST Engineering, increase in dividends, and all of it is being reflected in the share price for Semcom Industries. And those are two of the names that we have seen actually helping to boost the STI to above 4,000 points. Okay, so in terms of what to look out for in the coming week, we've got some of the names going ex-dividend, but a very key economic data point to keep a lookout for is the US non-farm payroll data coming out on the 4th of April on Friday, and that will be used by investors as a further indicator on the strength of the US economy. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis.
Hey, thanks, Gerald, for that insightful sharing of some of the Singapore counters that helped STI hit a new all-time high last week. So with that, I think I'll start with the Singapore market first. So last Friday, we can see that the STI index, I'll just remove this first. This was the previous week projection that we have of where STI will move. So yes, STI moved into the zone that we projected last week of the upside that is likely going to receive for the STI index. We hit a new all-time high of 4,005 points on Friday. After that, although we do close lower, but for the week, as Gerald showed earlier, we still have a positive closing. And today, STI is down, on the 1st of April, is down about 14 points. We are now back to the 3,950 points level, which is not a surprise because there is a lot of key announcement this week. One of them is the reciprocal tariff, the Liberation Day announcement, which will be coming up tomorrow. And of course, the non-farm payroll data that will come up this Friday. Okay, so there's a lot of volatility. So some of investors may be taking some profit off the table over here on the STI index. So the STI index now at 3,596 is actually using the previous high that we saw in February as a support level. So the resistance previously have a change in polarity and now becomes the new support level for the STI index. Okay, so below this level, we also see the 20 days moving average now around the let me pull out that level, around the 3,000. Okay, wait, I need to remove this comparison with the S&P 500 to get the reading. Okay, so the 20 days moving average is at a 3,900 point or 9,600 point level. To get is the if you round it off to 3009, that will be the key psychological support level for the STI index as well, for it to have a rebound to go higher. Okay, so these are the two key near-term support level that we are looking at. So I'm going to adjust the projection here. I think we are going to go with the key announcement coming up on the tariffs and the non-farm payroll number. Likely we will see STI move lower and test the 20 days moving average at around 3,900 point level as the support before we go up further towards the end of the year. Okay, some of the key analyst report that I read on the STI, we are projecting the consensus 12-month average target of the STI index end of the year will be around 4,250 to 4,260 points level. So we still have some headroom to go according to analyst projections. Okay, looking at the indicators wise, we can see that the uptrend momentum has been subsiding in the last two trading sessions, including today. So that is a sign that we will likely see a slowdown in the uptrend that we saw in the past 2 weeks or so. Okay, the RSI also tested the 70-point level. It reached a 69-point high last Thursday, and then it was rejected by that 70-point overbought level, and hence the STI come down to the 60-point level that we see today. Okay, so we expect the trend of the RSI to come down further towards the 50-point neutral mark at least, or even the 14 days RSI moving average at 56 before we see some kind of a substantial rebound happening on the STI index again. Okay, so STI will likely remain a range bound for now, using the 20 days moving average 3,900 psychological handle as a support. And then the 4,000 level will of course now be the pivot level. And if let's say we do well further, 4,100 will be the next immediate target that we will be looking at, which we will update you whenever we saw that kind of level approaching soon. Okay, so that is my take on the Singapore STI index. Next, let me move to the US indices, which has a very interesting sort of behavior, I would say. Yesterday on Monday night, okay, we began the trading day on Monday with a very big negative down kind of performance, but the Dow Jones Index and the S&P 500 managed to close the day in the green. Okay, but of course, for the whole week, it is still a negative week. So we can see that for the Dow Jones Index, it has also breached the 200 days moving average already. Last week, we tried to cross over that red line, which is the long-term moving average, but then this week we broke it down again. So that means the downside risk is coming back, okay? But the Dow Jones Index has not retested the low that we see in the middle of March, which is at the level of around, let me check over this. Okay, the low is around 40,600 points. So now the Dow Jones is at 42,000. So that is a sign that among the three US indices, the Dow Jones is holding up pretty well. And on Monday night, we also saw some of the very defensive names like Coca-Cola, okay, also holding up very well compared to some of the growth names or the tech names. So on the indicators wise, the MACD is showing that the uptrend momentum that we saw since the middle of March is subsiding right now in the last three trading session. We see a bit of rebound on Monday. So I think that for now, the Dow Jones Index is still quite safe. The crossover that we observed at closer to the end of March will likely still be intact. And Dow Jones Index in the near term has already seen the low in the March period and likely will rebound from here to try and get some kind of a footing of support on the 200 days moving average, which is now at 42,146 points. So that is the key level to watch. But then once it hits the upper bound of the Bollinger Band, which is now having confluence with the 100 days and the 50 days moving average, definitely pressure will come in again. So we expect the Dow Jones Index to move towards this gray shaded area right here. So it will move up above the 200 days moving average at 42,150 points, with the resistance now looking at 43,133 points, which is the upper bound of that Bollinger Band. Okay. So next, S&P 500. So similar kind of a indication. We got a negative week, but then on Monday we saw a bounce. So we actually went, S&P 500 actually pulled back more than 1% in early part of trading yesterday, but managed to close up 0.5% or 0.55%. So that's a good sign that some kind of rebound is coming in. But then, of course, the indicators wise still have not shown any kind of confirmation that this is the low that we are seeing. And S&P 500, I think, is now about 5% from its high that we see somewhere in the middle of February. Okay, so you can look at the chart now. The S&P 500 is firmly below the 200 days moving average. That means that market is very bearish right now on the S&P 500 index. And I think this 200 days moving average will now be the new resistance level that we are watching, because at the end of March, you can see over here, once we had a rebound and tested the 200 days moving average, it was rejected convincingly last week. And hence, this will be the new resistance level that we will be looking at going forward at 5,760 points. Okay, so I'm going to adjust the projection of the S&P 500. We are likely going to see the movement capped at the 200 days moving average at 5,760, with a support that we see around the 5,512 points level, the lower bound of the Bollinger Band, which could also be a signal that we may have formed a double bottom over here. Okay, so to read whether this double bottom can hold and that momentum can carry through to bring us back to retest the 200 days moving average, the trajectory of the MACD is still pointing upwards, although the momentum is coming down. So I think that there could still be some uptrend momentum presence in the S&P 500 index with the positive MACD histogram reading. But then that uptrend momentum is actually very weak right now. On the RSI, once we also saw it got rejected at the 50-point neutral mark somewhere on the 25th of March, and then it pulled back down towards the 14 days RSI moving average around the 40-point level. And this is also where the RSI reading is at right now. So I think the RSI will continue to track the 14 days RSI moving average, pushing it back up to the 50-point neutral mark. That will be the near-term target, which I think we will retest the 200-day moving average at 5760. So this is the range that we are looking at, 5,500 to 5,750 points level. That is where we see the S&P 500 moving in the next couple of weeks. Okay. Lastly, the index, the tech-heavy index that was impacted the most by the tariffs, and of course some of the AI developments in DeepSeek as well. So you can see that the Nasdaq Composite Index is down more than 10% this year already, from the high that we saw somewhere in this end of last year in December. So this is actually a very bearish kind of formation on the tech index, okay, tech-heavy index. We are quite far away from the 200 days moving average, which is the key support level for a quick substantial rebound to happen. But then we have broken down that level convincingly, and hence we are likely going into a downtrend for the Nasdaq Composite Index. So we are going to use some of the previous support level that we see. One of the line that we drawn here is the 17,032 points level. So that could be the support that we see somewhere in the July period. But I don't think that support will likely hold on, because the downside will likely, the momentum reading that we see in the indicators is likely going to see that the Nasdaq index will continue to fall further. Why? Because the MACD reading, as you can see, the MACD line and the signal line is having a very narrow margin now, and if a crossover happens, that could be a confirmation that we will see a further downside to come in very soon. And the RSI has also, once it touched the 50-point level on 25th March, it has also come down quite quickly, now even below the 14 days RSI moving average. So for people who are looking at the tech-heavy Nasdaq Composite Index, do expect more downwards pressure to come for the Nasdaq Composite Index. Do watch out for the MACD indicator for a crossover to happen. That means a negative reading on the MACD will likely signal that the tech index will move down further, and we need to wait for the RSI to cross below the 30-point mark before we see some kind of technical rebound. And the low that I think where the Nasdaq Composite might be moving could go and retest the low that we see in August last year, which was the Japan yen carry trade fear that brought it back down to the 15,000 points level. Okay, so I think until the tariff situation plays out, we will likely see the Nasdaq test the 15,000 level again before some kind of a rebound might happen, some kind of convincing substantial rebound might happen on the tech-heavy index. Okay, so these are my takes on the US indices this week. And of course, a lot will be happening with all the key macro data and announcements that will be coming up this week. So do stay closely watch to the markets to observe the developments. Okay, anything else to that, Gerald?
Yes, so quite a number of things to keep a lookout for. The first and foremost is the Liberation Day announcements on whether we'll see the tariffs coming through as expected. And then the next one will be the US non-farm payroll data on Friday, which will give us an indication on the health of the US economy.
Yes, so if you are worried about where the global market is moving, always remember that Singapore as a very safe haven could still have a place in your portfolio. So some of the key Singapore stocks that Gerald went through just now, even the Singapore banks are giving quite attractive dividend yield right now. So if you're looking for a safe place to park your funds right now to ride through the volatility in the US or the global markets, do look at some of the Singapore stocks that we cover as well. Okay. So these are all the time that we have for this week weekly market review, and we'll see you again next week on Monday in our next episode. Okay, thank you and goodbye.
See you.